everyone. Yes, my name's Omar Nagel. I'm a portfolio manager on the JP Morgan Global Emerging Markets Income Trust. And so in my session, I want to highlight the positive aspects of income investing in emerging markets and give you a flavor of how we manage the portfolio to achieve income and growth from this asset class. So in this trust, we invest in dividend-paying stocks across emerging markets with the idea of generating an attractive level of income for shareholders, and also to participate in the capital returns from emerging markets. We've got two targets. We want to have a higher yield than the broader market, and we want to outperform the broader market. And our benchmark is the MSCI Emerging Market Index. So pleasingly, when we look at the numbers later on, we'll see that we've managed to deliver on both those targets over a multi-year period. So buying dividend stocks in emerging markets can firstly lead to a portfolio with a healthy yield. So the dividend yield on the trust, as of today, the trailing yield is around 4%. So that nice healthy yield for any income investor is a positive. But we definitely want to make the point that an income approach is more than that in emerging markets. We can just think of it as a positive way to invest in the asset class, full stop. I often describe the approach as a combination, an attractive combination of value and quality. So value because we have a lot of discipline around particularly the yields of the stocks that we invest in and other valuation levels, and quality essentially because of our stock selection approach, what kind of dividend paying companies we buy. And one of the components of that quality tilt is a direct link that we make between dividend policy and corporate governance. So emerging markets, by definition, is at a different stage to developed markets, and we see that in the companies as well. So corporate governance, looking at corporate governance is really, really essential in emerging markets. And our view is that one way we can think about that is to look at companies that reward minority shareholders year in, year out with cash dividends. And to us, that's a very tangible indicator that companies are showing that they care about minority shareholders. So that dividend signal can be very powerful in terms of helping us to find the right kinds of companies to invest in the asset class. Well, I'll just carry on talking. I mean, when we go to the next slide, what I want to discuss is what kind of a yield portfolio we want to target. And let me start off with telling you what we don't want to do. So today in our team, we cover around about 1,300 stocks in emerging markets and Asia. And what we don't want to do is simply go and buy the highest yielding stocks in emerging markets. So that would obviously be a way of achieving a nice attractive yield, but my concern would be that then we'd also potentially be buying value traps or yield traps. So we'd have that nice chunky yield, but maybe then we'd be buying companies with poor balance sheets or bad management teams or some other kind of risks. So in fact, when we do that, if we think about that exercise and we think about those 1,300 stocks that we cover and we simply rank them by dividend yield, out of the highest 50 dividend yielding stocks in emerging markets, today we only own 6 within this portfolio. So instead, what we want to do is to build a portfolio with a much more balanced approach in terms of the kinds of yields that we're interested in. And this bell curve slide that I'm showing you here it's a sort of stylized version of what I'm trying to get to when I think about the portfolio in terms of dividend yield. So overall, we want to have a portfolio that has a higher yield than the market. You can see that in the middle of that distribution, most of the portfolio, around about 60%, is in what we call the target yield area. So 3 to 6% yield stocks. They're cheaper on average than the market. They're paying out a decent amount of their earnings as dividends, but we also see reinvestment opportunity for those companies. So they pay out some of their earnings as dividends to shareholders, and the rest they're reinvesting for future growth, which is just what we want to see. And on either side of that, that 60%, we have two other smaller portions of the portfolio. So 20% on the right-hand side, we do simply have some higher yield stocks. Normally, we're accepting a lower level of growth or some kind of cyclicality in the dividend. And then on the left-hand side, some lower yield stocks. So we will invest in some stocks where the yield is less than the market. And what we're looking for there is a superior dividend profile over a long period of time, and hopefully extra dividend growth. We only invest in dividend-paying stocks. So we will not invest in any zero yield stocks or stocks with yields close to zero. And our view there is really two things. One, we want every stock to contribute to income for the portfolio. And secondly, that governance point again. We really want to see the signal in terms of the management committing to pay dividends. So if you think that's the kind of yield distribution that we're trying to achieve in the portfolio, how do we actually build it? How do we actually find the stocks to build a portfolio that looks like this? So on the next slide, just thinking about how we actually go about finding these stocks. And today we have just over 80 positions within the portfolio. And it is ultimately about finding the right stocks. It's a very individual, bottom-up driven portfolio. I'm very fortunate that JP Morgan has a very strong research team. So within emerging markets in Asia, as I said, we cover 1,300 stocks. We've got 40 analysts helping us to cover those stocks. Global emerging markets means that we want to have a global team. So we have analysts based here in London, but also in Hong Kong, Singapore, Shanghai, Taipei, Seoul, Mumbai, and New York. And they're all operating with a very robust research framework, lots and lots of outputs that we use to build portfolios. But maybe I can just distill that all in just into three key questions that we're always asking from an income perspective. So whenever we're talking to the analysts or discussing with company management teams, these are the three areas I'm constantly referring to: return on equity, free cash flow, and dividend policy. So very simply, we're interested in companies that have a good level of profitability to generate earnings, and we want to see that profitability lasting for a long time. Free cash flow, very important. We want the earnings to be able to be converted into cash, because clearly you can't sustain dividends over a long period without generating cash. And then finally, that governance point again, the dividend policy. Clearly we want that cash flow to turn into income for shareholders. So by understanding those three elements, that's how we can make judgments on the yield, the resilience of that dividend, and the growth over our 5-year time horizon. So if we go to the next slide and just see what that adds up to in terms of positions within the portfolio. So these are all positions, these are all outcomes from our individual decisions, rather than having a top-down model that tells us to be overweight or underweight a particular sector or country. But I think it's really useful just to highlight where we're finding good income ideas within emerging markets. So from a sector point of view, we've often talked in the past about 3 key sectors within emerging markets where we do find good income stocks: consumer staples, financials, and technology. That remains the case. You can see that there are overweights and large absolute weights within the portfolio. And more recently, we've also been adding to consumer discretionary. So that's also become an overweight within the portfolio. So all areas where we can find these good stocks with profits, cash flow, and dividends. And from a country perspective, just to highlight a few positions, our largest active overweight is in Mexico today. And again, very simply, that's because we can find multiple quality companies within that market, which we think are trading at attractive yields, whether that's ranging from the consumer space, a company like Walmex in the retail space, or Banorte, a bank, or Gap, an airport stock. And conversely, if you look at our largest underweight today, that's in India. So that's just a place where very good market in terms of great companies in India, but also a place where there's a lot of optimism today, in our view, baked into the valuations. And so here we'd rather be much more disciplined in terms of waiting for a better opportunity to be able to buy stocks in India, or more stocks in India, at a better yield. Now, I've put two boxes on this slide just to highlight one sector and one market, which are both very important for the trust. So information technology I've highlighted, 21% portfolio weight and a small active position today. Very important because this sector has been a really positive contributor to performance over the last 5 or so years for the trust. And more recently, it's an area we've actually brought down exposure. So over the last year, we brought it down. It used to be our largest active overweight from a sector perspective, and now it's just a pretty modest overweight. And then on the other side, if we look at China, you can see 32% absolute weight, so again, very important within the portfolio. That's the place we've been adding to exposure in the last few years. From 2020 onwards up till 2022, slowly adding to our exposure and moving from an underweight position to a much more neutral position today, taking advantage of what we saw as attractive valuation opportunities in that market. So maybe just to expand on those two spaces, information technology and China, let's go to the next slide. And I just wanted to give you an example here within technology of the kind of stocks that we own. So I've highlighted here two stocks in the green boxes on the right-hand side, Realtek and Novatech. These are both semiconductor design companies. So they're designing chips that go into probably the kind of devices you're using at the moment. So anyone out there who's listening to this on headphones or through their speakers, that could be powered by chips designed by Realtek. And the screen you're looking at could well be powered by a chip designed by Novatech. The reason that I wanted to highlight these companies is they're just great examples of income investment opportunities in emerging markets. These are companies that can generate good returns, generate a lot of cash flow because they're very asset-light companies, and they've got great dividend policies. These are both companies based in Taiwan. Taiwan's a place where we see really positive dividend policies from management teams. And that's allowed us to hold great technology investments and receive good dividend yields over the years. And the right-hand side, I just showed this history of resilience. I really like the fact that these two companies have been, in the last 20 years, in the top 10 in terms of Taiwanese semiconductor design companies. The kind of thing we like to see because it just shows resilience in our holdings and durability in terms of the earnings potential and dividend potential. So let's go to the next slide, and here's China. And here I just wanted to highlight, obviously reopening has been a very big event in China from last year, reopening after the COVID-0 restrictions. And overall, I would see that as effectively just a tailwind for the Chinese economy and hopefully for some of the holdings in our portfolio. So I mentioned that we'd been adding to China in the last few years, and we went much more neutral, so we added a reasonable amount, mainly to consumer and financial stocks within the market. Just good companies where we saw better yields, better valuations, and better prospects going forward. I wouldn't say it was we weren't adding on the prospect of trying to time the reopening. That certainly wasn't our intention, or it was much harder to time it. It was much more about trying to take advantage of valuation opportunities as we saw them. But obviously reopening has happened, and what we think is that tailwind from a better Chinese consumer is likely to drive the economy certainly for the next year. And that bottom left-hand chart's really a good one, I think. It just shows how much savings, excess savings, the Chinese consumers built up in the last few years because they weren't able to spend, because the economy was locked down so thoroughly. And seeing the reopening, what we're starting to see is clearly Chinese consumers have been under pressure, and consumer confidence is starting from a low point now, but we're starting to see that improve, and that's likely to be pretty positive for our consumer and financials stocks within the portfolio. So let's just go to the last slide, just to highlight performance. And I think, I mean, you can look at the numbers yourself, but I think that the key takeaway here is that pleasingly, we do have a positive track record that we can point to over many years. So that value and quality combination that I talked about at the start has paid off, and we continue to see it being very relevant going forward still. We have a portfolio that's very different from the market. You know, we've got this very clear approach around income. We think it works over the long term. It does mean year by year we can have very different results compared to the market, and we're happy with that. But I think that's always something to highlight in terms of year by year volatility of relative returns. So I think that's probably a good place to pause. I hope I've given you a good flavor of why we think income investing in emerging markets is a positive approach, and a little bit about how we managed to build a portfolio that can deliver that consistent level of income to shareholders and also participate in emerging markets.